Good morning and welcome to the Killik & Co market update. It's been a reasonably good week for markets. Joe Biden made some comments about the progress that has been made in finding a resolution to bring up the US debt ceiling, and that has sent markets higher. In fact, the S&P 500 has reached its highest level for this year so far. Artificial intelligence continues to be a key topic in the investment world. 2 weeks ago, we talked about an online education company called Chegg, and Chegg had said it believes AI is harming its business because potential customers are using ChatGPT instead of Chegg's own offerings. This week, UK telecoms giant BT published results, and it spoke about how it thinks it will benefit from AI. It's been a tough decade for the company, as you can see by the weak share price. In its results, the company announced that it would be cutting 55,000 jobs, or 40% of its workforce, by the end of this decade. Some of these roles apparently won't be needed anymore. For example, the company is upgrading its networks and will then need less maintenance contractors. But many of the roles will be replaced by AI. Here's what the CEO said in the earnings call. We will be a beneficiary of AI unequivocally because we are a volume business. We've got 30 million customers, we've got lots of people, we've got lots of activity, and AI can help us to do that more efficiently. Commentary on AI is likely to become more and more common in earnings calls because investors are very keen to hear about how companies will be winning and losing from AI. This week, the key Japanese index, the Nikkei 225, has reached a 33-year high. Japan is the world's third largest economy, and it's a real leader in certain areas such as robotics and automation, which are both very popular areas to invest in at the moment. There have been some reforms to corporate governance in Japan, which some believe has made the country a more popular place to invest in. Historically, many Japanese companies have been quite cautious, and many of them have been sitting on large amounts of cash. The reforms are intended to make the companies do more with that cash in order to make themselves more profitable and in order to benefit shareholders more. Our research team has recently published a thematic note on Japan, so do give us a call if you'd like to give that a read. And finally, Netflix has announced it will be moving ahead with its crackdown on password sharing. The company estimates that over 100 million households around the world are sharing passwords, which means that Netflix is missing out on a lot of subscription revenue. Netflix shares are not too far from where they were 5 years ago. Here's the chart. You can see the shares did very well during the pandemic, but they sold off heavily in 2021 when growth in new subscribers started slowing. What's interesting, though, is that even though the share price is similar to what it was 5 years ago, the shares are now much less expensive. We judge this by looking at the price-to-earnings ratio, which compares the share price to the amount of profit that the company is making. In the quarter ending June 2018, the ratio was 178.7. At the end of the most recent quarter, it was 37.1. Price-to-earnings ratios are always worth looking at. Some people are reluctant to buy a share that's gone up quite a lot, but if the company has become more profitable, it may actually be cheaper in price-to-earnings terms. Moving on to have a look at next week, we are expecting results out from Intuit, SSE, Nvidia, and Costco. That's it from us. Enjoy the weekend, and we'll see you next Friday.